If your agency sells strategy but runs the books like a job shop, you're not pricing, you're guessing. And that guess may be costing you more profit than any client negotiation ever will. Hi, I'm Cody. I'm a CPA and certified tax coach, and we work with marketing and PR agency owners who want better profit, better cash flow, and smarter tax planning. Today, I want to talk about a mistake I see all the time. Agency owners say we're underpriced, and maybe you are, but very often that's not the real problem. The real problem is that the agency is undermeasured. You don't know which clients are profitable. You don't know which services are draining your team. You don't know whether your team cost is right for your agency gross income. And if you don't know those numbers, raising prices may help, but it will not fix the business. So in this video, I'm going to walk through how agency owners should think about agency gross income, owner compensation, value pricing, and clean monthly financials. Because if you want to build a more profitable agency, you need more than better pricing. You need better measurement. Point number one, stop measuring gross billings like their profit. They're a vanity metric. Let's start with the number too many owners brag about: gross billings. You hear it all the time. We're a $5 million agency, we're an $8 million agency, we're a $50 million agency. But here's the question. How much of that is actually yours? If you bill a client $100,000 and $40,000 goes right out the door for media, freelancers, production, or other vendors, you do not have $100,000 to run the agency. You have $60,000. That is why agency gross income matters. AGI, agency gross income, is the money left after you subtract your cost of goods sold. That's the money you actually have available for people, overhead, profit, taxes, and growth. This is where a lot of agencies get into trouble. They staff based on gross billings. They price based on gross billings. And they celebrate gross billings. But they do not manage the agency based on AGI, and that will create a dangerous illusion. The agency will feel bigger than it is. The team may feel busy. The owner feels like growth is happening, but cash is tight, profit is thin, and every new client feels like more pressure. That's not a pricing problem yet. That's a measurement problem. Before you say, we need to charge more, ask, what is our AGI? What percentage of gross billings is actually staying in the agency? Are pass-through costs being tracked correctly? Are contractors tied to client delivery sitting in the right cost category? Because if those numbers are wrong, your pricing decisions are built on sand. Point number two, value pricing still needs financial proof. And now, I'm a big believer that agencies should not price like order takers. If you're selling strategic thinking, business outcomes, brand positioning, demand generation, or reputational management, you should not price only by hours. That's where the value pricing conversation matters. Win Without Pitching has pushed agencies for years to think differently about positioning, expertise, and pricing power. But here's the part that gets missed. Value pricing does not mean ignoring the math. It means knowing the math well enough to price with confidence. If you quote a $25,000 strategy engagement, you should know what your delivery actually costs. How many senior hours are involved? How much account management time disappears into meetings? How much strategy time is really being used? How much revision time is normal? What margin should that engagement produce? If you don't know those numbers, you may call it value pricing, but internally, you're still guessing. And guessing is not a pricing strategy. And here's a simple example. You sell a monthly retainer for $12,000, and it sounds great. But if that retainer eats up senior strategy time, account management time, creative time, paid media oversight, reporting, client calls, and nobody is measuring the real cost of delivery, that $12,000 client may be one of your least profitable accounts. And that's why agencies need profitability by client, not once a year, not when cash gets tight, but monthly. Because the client who praises you the most may not be the client who makes you the most. And the client who looks demanding may actually be profitable because they buy cleanly, approve quickly, and respect scope. You do not know unless you measure it. Point three, Owner compensation is a business metric. Let's talk about something here. Many agencies often avoid this. Owner compensation. And I'm not talking about owner distributions here. I'm talking about whether the agency is producing enough profit and cash flow to properly support the owner's salary, retirement planning, taxes, reinvestment, and long-term financial goals. Your compensation is not a personal side issue. It's a business metric. If the agency has 20 employees, $4 million in AGI, and the owner is still underpaying themselves just to make the numbers work, that's not a healthy agency. That's a subsidized agency. The owner is absorbing the pain so the business can pretend it's profitable. And that usually happens for one of three reasons. 1, people costs are too high. 2, overhead is too high. Or 3, client work is underpriced or under scope. And sometimes it's all three. A healthy agency needs a financial model. A common agency benchmark is 55% of AGI for people, 25% of AGI for overhead, and 20% of AGI for profit before tax. Now, your agency may not hit that perfectly every month, but if you are nowhere near it, you need to know why. If people cost us 70% of AGI, you probably have a utilization problem, a staffing problem, a pricing problem, or a scope problem. If overhead is 40% of AGI, you may have software, office, admin, or operational costs that no longer match the size of the agency. And if profit is whatever is left over, you are not running the agency is running you. Let me ask you this. What do you think is the biggest profit leak in your agency right now? Is it people cost, scope creep, bad retainers, too much overhead, or not knowing your numbers clearly enough? Drop it in the comments, because this is where agency owners need to be honest. Point 4, clean monthly financials create better decisions. Here's where the CFO level wake-up call comes in. You cannot fix what you only look at once a year. If you are waiting until tax season to find out whether your agency made money, you are too late. Agency owners need clean monthly financials. That means your profit and loss statement should be accurate. Your balance sheet should make sense. Your accounts receivable should be reviewed. Your deferred revenue should be handled properly. Your cost of goods sold should be separated from overhead, and your payroll should be categorized correctly. Your financials should be reviewed in a way that helps you make decisions, not just file your taxes. And this is the difference between bookkeeping and financial leadership. Bookkeeping tells you what happened. CFO level thinking tells you what to do next. Here's an example. If AGI is flat, but people costs are rising, you need to look at utilization before hiring. If a large client is over 25% of AGI and also low margin, you have concentration risk and profitability risk. If project work is creating cash spikes, but retainers are shrinking, you need to look at recurring revenue and cash flow forecast. If the agency looks profitable on accrual financials, but you file taxes on a cash basis, you need to understand the conversion so there are no surprises. And these are not once a year conversations. These are monthly conversations, because agencies move too fast to manage from stale numbers. Point 5, under-measured agencies make bad growth decisions. Here's the real danger. When an agency is under-measured, the owner misdiagnoses the problem. They may think they need more leads, but they may actually need better margins. They may think they need more employees, but actually they need to have better utilization. They may think they need higher prices, but they just may need tighter scope. They think they need bigger clients, but they just need better fit clients. They think they need to scale, but they have not built the financial infrastructure to scale safely. This is why I want agency owners to stop asking only, how do we grow, and start asking, what kind of growth actually improves profit, cash flow, and owner compensation? More gross billings is not always better. More headcount is not always better. More clients are not always better. Better AGI, better margins, better measurement, better cash flow, and better tax planning. That's better. That is how you build an agency that gives you options. So let's recap here. Your agency may not be underpriced. It may be undermeasured. Start with your AGI, not gross billings. Know what money is actually available to run the agency. Second, value pricing only works when you understand delivery cost and client profitability. Third, owner compensation is not an afterthought. It is is one of the clearest signs of whether the business model is working. Fourth, clean monthly financials are non-negotiable. You need accurate numbers every month, not a tax season autopsy. And fifth, do not confuse growth with health. A big agency with weak margins is just bigger problems. All right, before you go, if you're an agency owner and you want to keep more of what you make, I've got two things for you. First, grab a copy of my book, The 12 Biggest Tax Mistakes That Cost Agency Owners Thousands. It breaks down the exact mistakes I see every day and how to avoid them. Second, if you want to see what this looks like for your business, get a free tax analysis. We'll take a look at what you're doing now and show you where you might be overpaying. And if this video helped you, make sure you subscribe so you don't miss future strategies on tax planning, cash flow, and building a more profitable agency. I'll see you in the next video.